Today we will be looking at Broadcom Stock with the ticker symbol AVGO, which is a semiconductor manufacturing company like Intel or AMD or TSMC, for example. It's, I think, similar to Infineon, which is a German chip manufacturer you could look at. I think Infineon even has better growth potential and a lower price to earnings ratio. I think Broadcom is more in the sector of chips for routers and network related devices, I think. First we'll look at the chart and we'll see that it's not really at a discount right now, but it's rather at its all-time high almost. So first we will look at the market cap, which is really high in this case, 340 billion. Now let's look at their revenue. Let's look at the revenue. It's rising every year, but it's almost at Intel levels. I mean, Intel is at 60 billion revenue and Broadcom is at 33, so it won't probably grow that much in the next few years. Now we look at the net profit, which is positive and also growing, and the shares outstanding, which are slightly the same. So they stayed the same, which is a good thing. Then we'll look at the cash flow statements. Cash from operating activities has grown from 3 billion to 16 billion, and free cash flow has grown from 2 billion to 16 billion. So they have almost the same free cash flow as cash flow from operating activities. At the balance sheet, in this case, we would look at the net debt, which means they have 27 billion of debt, of net debt, and their total debt is 40 billion around that area, and their net income is 11 billion, so they would need around 4 years to pay them off, and their cash flow is higher than their net income, which is also a very good thing. Let's calculate the value of Broadcom. So we will first put in our desired annual return of 15% per year, which in this case is AVGO, the stock ticker symbol, of 33 billion. Then our revenue growth rate, which would be 3% in the lowest case, I would assume. 9% just to see what it would look like in this case. And price to earnings of 15. Yeah, I think that's reasonable. Which would also give us a buying price of $41. So in this case, with these assumptions, it wouldn't be a good stock to buy. Now we'll increase our profit margin to a more reasonable 12%, let's say. In this case, I would look at Intel's profit margin. And Intel's profit margin is got a buying price of $54. With our profit margin of 12, let's put it to 24% of the average. In this case, it was higher and it was lower, so we'll put 24, which could be seen as high, but it has also increased, so I would say 24 is reasonable. That would be my assumption, and for our revenue growth we would pick 5% maybe. Billion, we could also pick 7%, which would give us revenue of 64 billion. I think 9% would be reasonable to higher in this case, and it would give us a buying price of $190 because the stock is at 800. Maybe a higher profit margin in this case, 30%. In this case, with 30% growth rate, we would have a buying price of $240, and maybe let's turn up the price to earnings to 20, but I wouldn't really go higher than that. So these are even a bit high assumptions with a buying price of $322. The highest I would go, I would increase the profit margin to 37%, 34% first, and then 37%, which would be the highest profit margin, and this would give us a buying price of $400 around that area. Revenue would be increased to 12% maybe. Yeah, and price to earnings to 25, and then you could argue for a buying price with these really, really high assumptions. You could argue for a buying price of $650. So with this model, it isn't really a buy. And then I will look at our other model. So here we enter again our stock ticker, AVGO, and we have to look at the numbers of Yahoo Finance. In this case, we would have a growth rate of 10% for the free cash flow, 5% discount rate means the desired annual return of 15%. Then we will terminal value of 15. Yeah, we can also put 10 first. Here 0 free cash flow would be 16 billion. Stock-based compensation would be 1.5 billion. And then for our net debt we'll put in minus 27 billion. And our shares outstanding are 423 million. This would give us the result that the stock is currently overvalued, and you should buy it at $369, which would also be the price I would recommend you to buy the stock at. With a terminal value of 15, we would get a buying price of $456. As you can see, Broadcom is a bit overvalued right now with $800. But if you bought it a while ago, let's look at the chart. It was at $400 like when it crashed due to inflation and stuff like that. And before it was also underpriced, and right now it jumped up these weeks. Maybe we will get some answers here, like an earnings release or something. Yeah, earnings release. Yeah, I don't really know why it jumped up that much, but like I said, if these numbers sound reasonable to you, your buying price would be $456. I would rather go to 300, to be honest. If you like this video, give it a like, and bye.